Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Michael DiGioia, Director of Institutional Sales at DAS Trader, to discuss options, expiration trends, and trading strategies. Michael, it's great to see you. And let's talk about some of those vol trends that we saw from October to November, since election day is finally out of the way and we've started to receive some positive vaccination news.
Yeah, so I think that a lot of the hedges that were put on due to the uncertainty around the election are starting to be taken off. So what we've noticed is that the VIX, the VXX, and the VIX have kind of come down to unprecedentedly low levels. I mean, basically, we're at pre-pandemic, pre-COVID levels. It's not quite there yet, so it looks like we might have a little bit more of a washout to the downside. And then thereafter, the question is, you know, volatility as expected. As you go further out in time, January, February, March, it looks like the expected volatility in the options pricing therefore increases from January on.
Right, and of course it makes sense because it's hard to determine what's out in the future relative to what's out a few weeks in front of you. So let's talk about that, Mike. How do you trade options expiration? Give us an example of how you work through that.
Yeah, well, so one of the things that someone might want to consider as an educational kind of trade to watch is if you go long the puts around 350 on the S&P in March and then short the puts at 350 in December, you'd be basically benefiting from a possible move to the upside going into the holiday season. It's a very seasonal trend for the markets to kind of move up going into the holidays. And then thereafter, you'd kind of benefit from having the opportunity to additionally write into the expiration into January, and or potentially add to your put on the downside to take participation in further downside move if the market does start to sell off. As you know, I mean, the markets are kind of at unprecedented valuations going into the end of a year in a very mature trend. So this way you'd benefit from some of the time decay going into expiration in December, potentially even into January, and then participate in some downside move as the market pulls back. And I'm not even saying that this has to be a massive correction. It's a healthy correction after a massive move to the upside.
So what kind of strategy is this? How would you manage it if you hit certain targets, whether it's earlier or later down the line? What kind of strategy is this?
So basically, this is a put calendar spread. In essence, you're shorting volatility going into the end of the year, and then you're benefiting from a possible normal correction thereafter as the Christmas rally tends to peter out and we go into the post-earnings season, February, March time period. So this would be a put calendar spread, and it would be a diagonal because you're not purchasing the same months.
Right. That's a good point. And I think this kind of strategy, considering what we're going in from a fundamental perspective, we have a transition of power in the White House, which is a big event globally, of course. Then we have to think about the dissemination of vaccines. And of course, what is the first quarter going to look like? Will we even have any type of growth since we're experiencing lockdowns again? So I think it makes sense when you think we might come down towards the end of the year. But then, of course, there are a number of outliers that we need to look for in Q1 and possibly for Q2.
Yeah, and there's really two other variations I'd like to point out. So number one, people need to know that the VIX is inverse to the market. So volatility goes up, markets go down, right? So we're basing this trade off of the VIX, the VIX or the VXX. And the next thing I'd like to point out is you could also play this as a possible VIX calendar spread. So you could play it on the other direction by buying calls and then writing the calls by playing the actual VIX or the VXX. So that's another variation. And basically, this is all about volatility. I mean, we're basically coming into massive support on the VXX and the VIX. And the markets are also coming into resistance. And this trend has been pretty much going and plowing along since pretty much the middle of March. So the market's kind of at a very extended point. Valuations are very high as we come into earnings season. And to top it all off, we have a transition of power potentially as we go into January, right? Nobody really knows what's going on with the political situation. So we're really getting a trifecta of events that could potentially make this trade work out. And of course, obviously, no trade is perfect, but we do have a lot of indications and signs showing that this is all coming together at this particular point in time.
All right, Michael, good stuff. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Joe. Bye-bye.